Hello, everyone. I'm Peter Lemieux, and I'm going live on YouTube to talk about auto policies. I'm early, so I'm going to wait a little bit till we get some people here. But that's my story, and I'm sticking with it. So I see somebody joined. I just want to let you know I'm Peter. I'm going to talk about auto policies in a few minutes. It's not quite the top of the hour, but you're on the right place to hear a live presentation on auto policies. And welcome all of you. So, so while I wait till close to the top of the hour to actually get started, I will give you a little introduction about who I am. My name is Peter Lemieux. I work with Melissa Dillon at the Insurance Exam Queen. I actually have worked with Melissa for several years before she was the Insurance Exam Queen. We have been teaching people around the country how to pass tests, and I always admired everything that you guys like about Melissa, her energy, her great teaching ability, and things like that. So when she ventured off on her own, I asked her if I could give her some assistance and encouragement, and she accepted my offer. So right now I'm helping her with some live classes. Today we're going to do auto policies. I got one scheduled tomorrow, I see, on life and health taxes, which probably none of you are interested in because you're taking P&C. But I wanted to tell you about it. I have been in the insurance business for 51 years. I know you're saying that's impossible. Did you start when you were 5 years old? No, I didn't. So I'm older than you might guess. But 51 years ago, I went into the life insurance business, and that graduated into other fields. But for the last 15 years, I have had more and more focus on teaching, helping people pass the state exams. So that's really what I do most of the time. And today we're going to talk to you about auto insurance. And I don't think it's too early for me to show you. I am trying a technological experiment here because I'm not a techie guy. But I thought it would be fun to start off a show on auto insurance with a song. So I'm going to see if I can get that up and raring to go. By streaming. Let's see. So let's see if we can do this and if it'll make any sense whatsoever on our class. Let's begin our class. Sure. I'm getting there.
Maybe you can drive my car. Yes, I'm gonna be a star. Maybe you can drive my car, and maybe I love you. Beep, 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 yeah.
So there we go. A little start with the song Baby You Can Drive My Car. And that was to introduce us to the class with a little bit of music, and I decided not to go with the Beatles, the original song people, but with a couple of ladies called the Mona Lisa sisters, I think it is. Baby, you can drive my car. So we're going to talk about auto insurance. Um, so with me, when I try to do something a little bit out of the ordinary, it's always guesswork whether that's going to do anything or not. But we got it through that one. You guys can't talk to me, so you're going to have to rely on the chat box to communicate to me. And I do appreciate any communication in the chat box. It helps me know if you can hear me and you can see me, if things are working, if they're not working. So the first big question of the day, did you like Baby, You Can Drive My Car to start off our class? So I can't see your answers, so you got to put it on the chat box. And if nobody answers, I will never play music again at my classes. So much pressure on you guys. Well, I saw a heart. Okay. That's all it takes. I need very, very little encouragement to keep going. So today we're going to talk about auto policies. I did put together some slides that I will be using off and on. The purpose of the slides is to keep me on topic. Okay. So I don't wander too far into the weeds and talking about this stuff. You know, you guys are studying for property and casualty. A property policy protects stuff. It protects your property. Okay. So it would be buildings, cars, stuff, right? Um, Casualty policies actually protect other people. Other people would be people you injure, them, bodily injury, or their property, and you're to blame. So with a casualty policies, you're actually protecting someone. We have no idea who that will be, but it's somebody that you injure. So the first question is auto policy a property policy or is it a casualty policy? And interestingly enough, it is a casualty policy, a liability policy. But Peter, we're protecting our cars secondarily. The reason we know this, and I'm going to get right into this with my slides. If you want to know what kind of policy you're studying, look at coverage A. In a dwelling policy and a homeowner's policy, coverage A is the building. It's property. In an auto policy, what is coverage A? It's liability. It's covering other people that you may hurt. Therefore, an auto policy is technically a casualty or liability policy. So that's where we're going to start. Allow me to just pull up my slides. And the first slide says Insurance Exam Queen, personal auto policies. Now, what we know right now that personal auto policies provide coverage for individual drivers and their vehicles. Now, somebody's going to ask, will this conversation today also include commercial auto? Only superficially, but I am going to talk about it at the end, okay? Now, I am going to talk for a while. I know people come in and out with these live classes because you're surfing the internet and things like that. But this topic on auto, I'm going to stay with for a little while, perhaps even as much as an hour as I go through this. If you're here to really learn about the auto policy, I strongly suggest you use notes. Okay. So the personal auto policy, exactly as it says there. The parts of the personal auto policy. Now you've got A, B, C, D, E, F, and then we're going to also talk about an umbrella policy. Part A of a personal auto policy I have already told you, is liability. Liability protects bodily injury and property damage of someone you injure. We don't really know who's going to get paid because we don't know who you're going to injure, correct? So that's the first thing we want to know. Part A covers liability. Let's stay on this for a while. With what appears to be a complex slide, it isn't. Just work with me. Liability. You are responsible for bodily damage and injury and property damage of the people you crash into. This is the only coverage that states require. You say, my state requires me to carry auto insurance. The only part they require is the liability. Their concern, all insurance departments' concerns, are to protect the public. They really don't care that much about your car. Okay. What they do think about is that car, that 3,000-pound piece of metal flying along at 60 and 70 miles an hour can seriously injure, it can even kill other people. The state wants those people protected. That's why liabilities are a requirement. Now, what we see here is it's a big bucket of money that can be paid out either in the aggregate or in split limits. My next few slides will explain that. Well, we try to explain it here a little bit. The aggregate is you have a certain amount of money, and that's used to pay all your claims for the year. So if you have a claim, imagine you have $500,000 of aggregate coverage, and your claim uh, incurs $100,000 of injuries. What happens is when the insurance company pays that 100,000, you only have 400,000 left for the rest of the year. It's not per accident, it's per year. That's the way aggregate works. The more common one is what we call a split liability. Go to the bottom and you will see 25, 50, and 20. Now, we're going to explain this a little bit more, but 25 is bodily injury per person. 50 is $50,000 bodily injury total. That's per accident or event. And the 20,000 is all on property damage. So your Part A liability on 20, 50, and 25. If you injured 3 people, person 1 has 30,000. How much are we going to pay that person? We're only going to pay them 20. Okay. The second one had 15,000. We're going to pay that person 15,000. We've paid out now 40,000. Your maximum total is $50,000. So that means when we get to property damage of 40,000, wait a minute, person 3 had 40. I read this wrong. Person 3 had $40,000 of injuries. We paid out 25 for the first person, 15 for the second person. We only have $10,000 left for the third person. I'm not talking about property damage here. Forgive me. So what happens is I only have 50,000 total for bodily injury. We pay out 25,000 to the first guy, pays all his bills. The second guy had 15, we pay that. That's 40,000 has been spent. There's only 10,000 left for guy number 3 who had $40,000 of damages. Once you hit your limit, the insurance company is not going to pay any more money. But that would be how a split limit works. Liability, you're responsible for bodily damage, injury, and property damage of the people you crash into. So, again, did I go backwards on my slides? No. Let's just focus for a second on the split limit. It tells you the most we will pay any one person is 25,000 for bodily injury. The most total for bodily injury is 50,000, and the most total for property damage is 20,000. There's no example of the property damage on this claim. But if there had been 15,000 of property damage, we could have paid that. So what I want you to think about for a second, in an accident, what is the most insurance policy could possibly pay out? In a perfect case scenario, what would exhaust their policy? I'm trying to see if anybody's even trying to communicate to me. It is $70,000. Now, Peter, how did you get that money? 25, 50, and 20 is not 70. Bodily injury total is 50. No matter how many people get hurt, we'll never pay more than 50. Property damage is 20. We'll never pay more than that. The total, most this policy will ever pay is $70,000. Now, if that's not enough insurance, obviously you need to increase your limits. That's a split limit. Now we want to talk about, we're still on Part A liability. What happens if somebody buys an aggregate policy? Seems to me like my slide. There we go. Aggregate maximum is how much money you have for the policy year. So it's a big bucket of money. Maximum aggregate is per person 50, property damage. The most that this policy will pay is 70,000. That's not an aggregate policy. That's a split limit policy whose maximum is 70,000. Okay? Maximum money available for all your claims in a period of time is $70,000. Sublimit of liability that you can put in on each claim and the accident. Split limits, stated limits, bodily injury, and property damage. Oh, I see what she did here with these slides. Maximum was at the top. We're looking at a split limit. We're now going to discuss a maximum aggregate. You have an amount of money that's payable over the course of the policy year. It's not per accident. So if we had a $70,000 worth of damage on claim number one, but I was carrying a $500,000, I have 430,000 left for the rest of the year. You could, in theory, exhaust your maximum before the year is out and have no more coverage for the rest of the year. But maximum aggregate, please try to remember it this way. It is the most money we will pay out, not per event, but per year. There's an accident. Sister, dad, mom, and bro are in this accident. 5,000, 30,000, 20,000, 15,000. That's 35, 55, $70,000 of injuries to this family. Now, on a split limit, we could pay 25 on the first one, 25 on the second one, and then there's nothing left because that 20,000 is for property damage. 25, 20, and then there's only $5,000 left. For the third one, and the fourth one's going to get nothing. That's how split limits work. So the question is, your liability is 25, 50, and 25. You injure 3 people, 30, 15, and 40. How much did that insurer pay? The most that they can pay in bodily injury is $50,000. never more than 25 per person. But these injuries are over 50,000, so they'd stop at 50,000. And that's exactly what the slide shows us. Now, what's not discussed in the slides is an aggregate policy. The aggregate policy would list one lump sum of money. Usually it would be larger than 70,000 because it's going to cover all your accidents for the year with that lump sum of money. And if you had, we'll use my example of 500,000, there would be enough money to pay. Let me go back on those slides. If I had 500,000, I could pay 30, 15, and 40. Okay, that's $85,000. I have enough money to pay all of that. But then I only have 415,000 going forward into future claims. So you have a big bucket of money and it goes down. In a split limit, that's the most per accident. Now I happen to think I make a lot of sense. I have people who live with me who tell me that's not always so. Did the explanation of how split limits and aggregate limits work make sense to you guys? Um, I need someone to write on the chat box if that's making sense or not. If not, I'll just keep talking and assume you guys just love hearing my melodic voice, and I'll live in that. I'll live in that fantasy world. I see a heart, just like Valentine's Day. Well, thank you so much, Yolanda. It means a lot to me. You got to appreciate, folks, what's going on here today. I'm sitting in my office talking to my computer. There's nobody else in this room. I mean, if you didn't know better, you'd have the people from the funny farm come and take me home, just sitting here talking to my computer. And if I don't get feedback from you guys, I begin to feel a little nuts after a while. Thank you for the feedback. We are now going to talk and go on in the auto policy to Part B. Part B is med payments, medical payments. These are payments that take care of small medical bills. Okay. So first of all, this is not coverage for people you injure. They're covered under liability. This is for you and your passengers that are in your car who get injured. We have a payment called med payments to help them with their bills. It covers up to 3 years because sometimes you can say, I'm not hurt. And 6 months later, you find out you have a back injury that came from that accident. It'll cover up to 3 years from the accident. There is a per person limit, which is usually quite small. It's really, I'll just say this, med payments, whether it's on homeowners or auto policies, are designed to take small medical bills and just pay them and not argue about who's to blame. We won't use any of this money to pay people we injure, but it will cover you and your passengers up to a certain amount. No question about who's to blame. That's what medical payments do. So let's say you have a $5,000 med pay limit and someone in your car breaks their arm. They can collect on your policy up to $5,000. If the medical bills are 10,000, we're only paying 5. But it's designed to pay small medical bills. But med payments in an auto policy, I think this is important, folks, to make note of. Med payments in an auto policy are for you and your passengers. That's technically insureds. If you look at who's insured in an auto policy, it's people in your car, not just the driver. But in a homeowner's policy, just to really mess with you, med payments pay everyone but the insureds. So in a homeowner's policy, if someone's visiting your house and your dog bites them, and they need $800 to stitch it up, that would be med payments on a homeowner's policy. We're not paying anybody else on an auto policy, just you and your passengers. It's a distinction between the two, even though both are called medical payments. All right, Peter, I got that. Liability, med payments. What's part C? Uninsured and underinsured motorist. We got to focus on what the word says, okay? An uninsured motorist means they don't have any insurance. So it would somebody who doesn't have any insurance, if they don't have Part A insurance, which is liability, which is required, okay? A hit and run case is a good example. We don't know who hit us, so we don't have any idea if they have insurance or not. If we can't find them, we're going to assume that they're uninsured, okay? Also, if somebody were driving and it's not on the slide, but their insurance company was bankrupt, they're uninsured. Then there's the person who is underinsured. They have insurance, but not enough. So let's just assume a simple accident. They do, you're driving a Lincoln Navigator worth $70,000 and they damage it and the damage is $40,000. Their property damage only is good for $25,000. They would pay their $25,000. You could collect the rest from your uninsured motorist coverage. Okay? They have insurance, but it's not enough. That's the difference between uninsured and underinsured. Let me go back to my screen where I can see the questions. So far, we're doing good. You're not asking questions. That means I've either completely bored you, sent you surfing the net for other things, or you're relatively doing okay on what I'm teaching. Bodily injury coverage for you and your passengers if they hit someone who has no or not enough insurance. You need to use Part D, damage to your auto. Okay. So if there's somebody in your car who gets hit, okay, and they don't have enough insurance, you use Part D, damage to your auto. But let's stay on Part C. Part C, uninsured motorist. I do want to mention something here. There's sometimes confusion as to how uninsured motorist is. So I'm buying an auto policy. I choose how much coverage I get in Part C. Let's say I get $50,000 of uninsured and $50,000 of underinsured. So if somebody has no insurance at all, I can collect $50,000 from my own policy to cover damages. If somebody with insurance but not enough wrecks my car, let's imagine that they have a state minimum of 25,000. I have 50,000 of underinsured motorists. Here's how they pay out. They pay out the difference between what the negligent party had and what you cover. I cannot collect on that example. I hope you're with me. $50,000, even though I bought 50,000 of underinsured motorists. The 50,000 is they'll pay the total amount of the accident up to 50. If you collect 25 from the other guy, there's an extra 25 to help you out. So please understand that 50,000 is the total amount from the underinsured and from your policy. It's not all from your policy. People get confused on that. I think it's important, and I hope that helps clarify some things for you folks. What we're doing so far, as you can tell, is we're just proceeding through the policy. We got liability, med payments, uninsured and underinsured motorists. Now we get to the famous Part D. Part D is damage to your auto. So many people think they buy auto insurance to protect their car. Well, yes, if you have Part D, Part D is not required by law. But you may say to me, Peter, I was told by the bank I had to cover my auto. If you borrow money on your car, your lender can require you to cover that car because they gave you money to protect that car and they want it insured. But it's not state law that you carry Part D. Your lender can require that. Okay. And so it covers the vehicle in case it's damaged. Part D. How that works is it breaks down, first of all, it pays out repairs on an actual cash value basis of your car when it's damaged by collision and other collision. First, allow me to explain ACV. If you guys are taking homeowners, you should have a feeling about it is the value of your car when it was new minus depreciation. So it's not worth what it was when it was new. And the older it is, the less value it has. There are some insurance companies who offer replacement costs on your car. It makes for good advertising, but it's a very expensive option. And I don't know many people who choose to pay that they get a brand new car. You're going to get the car replaced for what it was. It was a 2015 Volvo, whatever model that is. They'll give you enough money to go out and buy a used car at that actual cash value. So, actual cash value is important to remember, as that's how they pay out on your car. But there are two types of property, of damage to your auto claims. A collision is a car crash. Okay. You hit or crash into something, or you're driving and something crashes into you, although that is going to be covered on the other person's liability. Okay. But you have a car crash. That could be you are in a parking lot and you back into a telephone pole and you do a mess on the back of your car. That's collision. In my mind, and know this is oversimplified, it may not work if you have a real technical, nerdy person on auto policies. They may say that's not 100% correct. But to me, it's cars in motion. Okay. That's kind of what collision is. The other one is called other than collision. That's what's on the test. Some insurance companies call it comprehensive. It's things that happen to the car other than collision, like Mother Nature. So these are things that your car wasn't in motion when you hit. Well, it was. Let's talk about the animal last. When a fire breaks out in the car, or someone wrecks your car, vandalizes it, you get hail damage to your car. A flood comes through and does damage to your car. A tornado comes through. Those things are all covered in other than collision. The one that messes people up is the animal. You are actually driving here and you hit an animal which does great damage to your car. The assumption is you were not driving down the road looking for an animal to hit. The assumption is the animal ran into you. That makes it other than collision. So that's, you got to know the difference between those two so you don't let the state trick you with questions on collision and other than collision. Um, the limit of liability is the lesser of repairs for actual cash value. What we mean by that is your car is wrecked, and the insurance company is either going to total it out and give you the actual cash value, or they're going to fix the car. They're going to do the less expensive of the two. If your car's worth $12,000 as a used car and they can fix it for 8, they're going to fix it. If it's worth 12 and fixing it will cost them 15,000, they're going to total it out and give you the $12,000. they're going to do it for the lesser to the insurance company. But that's the way that works. Um, I want to stay on this one just for a second. I want to use an example. Hopefully, this is helpful. Damage is done to your car by a tree. That can either be collision or comprehensive, and let me tell you how. I am driving down the road and I crash into a tree for whatever reason. That's obviously collision. My car is parked and a dead tree falls on it, or a storm, a lightning bolt hits a tree and it falls on my car. That's other than collision. Both are car and tree, but the event is different. And that hopefully will help you tell the difference between what's collision and other than collision. We're ready to go into part E of your auto policy, which is duties after loss. There's nothing hard in part E. There's nothing on the test that should confuse you, but it's in the policy. It tells what the insurance company expects from you after a loss. To me, it's common sense. I don't think anything on here is worthy of a trick question. Number one, communicate with the insurance company after the accident. They don't want to hear that you had a loss 2 weeks ago and you never bothered to call them, and now you want to tell them the car is wrecked. They want you to communicate them in a timely basis. Obviously, if you're in intensive care, you can't communicate them with if you're unconscious. Communicate with the insurer after the accident. Hit and run, theft, whether it's comprehensive or collision. But what we have right here with hit and run and theft are things that are crimes. So, on top of communicating with the insurance company, if a crime's committed, we want a police report. In fact, when there is a car accident and police come on the scene and one of you gets ticketed, the insurance company wants to see that report to see who's to blame. So which insurance company's got to pay. Okay. So we've got to communicate when proper, we get the police reports. And that's really all on duties after a loss. You're supposed to take care of the property. In other words, they don't want you to leave your damaged car on the side of a public road for a couple days where theft can occur and come back and the tires are missing and the car's been broken into. The insurance company wants you to protect the property. Another thing I'll mention here, which comes up on the test, is the word salvage. If the insurance company totals your vehicle and they give you the $12,000 for your car, they now own the wreck. You don't own it anymore. They own the salvage, and they can repair it and sell it. They can sell it for parts. They can do what they want. It is no longer yours. Salvage belongs to the insurance company. May I trouble you with a story that shows it to the extreme? My next door neighbor had their car stolen out of their driveway. The police came and they told him, look it, if we don't find this car in 24 hours, you can consider it gone. I live in Arizona. It's near the border. People run it across the border. Or they take it to chop shops, change the VIN number and whatever. So a few days went by. The insurance company was notified. The insurance company totaled it out and gave him the money to go buy a new car. 1 month later, this is crazy. 1 month later, the police called him and said, you're not going to believe it. We found your car. It's in perfect shape, is parked in a road. Whoever took it for a joyride and just left it there. There's no damage to it at all. But it wasn't his car. It now belonged to the insurance company. His first inclination is, great, I want my old car back. Once you took the check and went and bought another car, that car is no longer yours. That's salvage. Okay? Let's talk about Part F, the final part of your auto policy. Part F is called General Provisions. I'll tell you how Peter explains general provisions. It is the auto policy's junk drawer. All of us have a junk drawer in our house. When we don't know where something goes, we throw it in the junk drawer. I can't find it. The first place I look is my junk drawer. That's kind of what insurance companies do with general provisions. These items that are in there don't belong in the first 5 parts of the policy, but they're part of the policy. So we put it in general provisions. Okay, so what are some general provisions? Um, what happens in bankruptcy? Um, no benefit to the bailee. Bailee is someone who has your property and it gets injured in their possession. Your insurance company is not going to pay the laundromat for ruining your sweater. The laundromat has to have insurance. Same thing if you have an auto in the possession of a repair shop and they damage your auto policy is not going to cover that. We don't pay when it's in the possession of somebody else. I want to talk about subrogation. Um, I'm going to explain subrogation to you in a non insurance term, okay? My wife and I were talking to each other and we heard a crash from the kitchen. We went in the kitchen to find our 12-year-old had, with his new lightsaber, smashed my wife's favorite vase. And it was laying broken on the floor. So I then introduced my son to subrogation. I told him, "You're to blame for this. You are going to pay for a new vase." "I don't have any money, Dad." "Okay, here's what's going to happen. I'm going to buy a new vase for Mom, and you're going to pay me back from your allowance." I subrogated against the guilty party. I paid for it, even though I wasn't to blame, and he had to pay me back. That's all subrogation is. Your insurance company pays a claim when somebody else hits your car. They will then subrogate against the other driver's insurance to get collection back. That's all it is. The slide says right of the insurer to take legal action against a third party, my son, that caused the loss to the insured in order to recover the amount paid by the insurer for that loss. That is a simple story to understand the word subrogation. Okay. Um, See, insurance company, I didn't read the part. Transportation expense, $20 a day to maximum of $600. Change the way they pay the claim because the person is bankrupt. Look at bankruptcies that are more than 10 years old. It has no bearing on the claim. So your personal bankruptcy has no bearing on future claims. That's what the bankruptcy clause is. But it's items like bankruptcy, no benefit to bailee, and subrogation that will settle in the junk drawer. And we call it general provisions. For my purposes, I honestly believe what you need to understand is how med payments, remember, only covers those in your car and yourself. C is uninsured and underinsured motorists. D is the auto, and E has to do with duties after a loss. Understand that, and you really got the flow of the auto policy. However, not to let this whole thing die on the vine. Oh, this is just blowing the slide up. I've already told you all this stuff. Okay. Let's talk about an umbrella policy. We're going to use an umbrella policy when we look at our limits of liability and we say, I don't have enough coverage. My property damage on my car, let's say it's the slides, is $25,000. I cannot total a new car because I don't have enough coverage. If I total somebody's new car, I'm going to have to pay. I get 25,000 on a $50,000 car. I personally now owe the other person $25,000 because I didn't have enough insurance. Well, the way you do that is to get extra liability or an umbrella policy. I'm going to just mention a couple things about an umbrella policy. It provides additional coverage in excess to the primary policies on your home and auto. Now, in fairness, if you want to buy an umbrella, they're going to require you to carry a base amount of liability much higher than 25,000. Some of them require that you cover $1 million, and then you buy an umbrella on top of that. But umbrella is a separate policy. It's different than just increasing your liability. If you want to increase your liability, and you look at your auto policy after this class, you call your agent up and say, I don't have enough liability. I want to kick it up. He just kicks it up and you pay the extra premium and you got more liability. But some people need more than what your personal auto policy can provide. So in that case, you would purchase extra coverage in an umbrella policy. So an umbrella policy can stand on its own. Umbrella is a good word because when you use an umbrella, it goes up, it goes out. It gives you extra coverage and you can cover things that aren't covered in your base policy. You can tap into the umbrella policy to pay the remainder of the bill. Give me an example of what's not covered on my base policy that can add to an umbrella. Personal injury. Someone's reputation is hurt. That's not covered on your auto or homeowner policy. It's covered on business or commercial insurance. An umbrella policy will allow you to do that. Well, I used to think to myself, as just Joe Blow driving a car, how can I hurt someone's reputation? Not easily. But we live in a new world now. We live in a world of internet and streaming. You can say stuff on your own website, your podcast, whatever you have going on, especially if you have a lot of followers. You can say something and then find out you're now being sued for damaging the reputation of somebody in your comments so badly that they're having trouble getting a job. Okay. That lawsuit is not covered on your homeowners and auto policy. But if you had an umbrella which allows you to cover personal injury, that could be covered on your umbrella policy. Okay. It goes up and out. That's an umbrella policy. If there's an emergency, you tap in the umbrella to pay the remainder of the bill above and beyond what's covered on your policy. And if your policy doesn't cover it, then you at least have coverage with an umbrella policy. That's different than an excess policy. In an excess policy, you cover the exact amount or less than the auto and homeowner policy. The primary underlying policy pays first, this pays second. It doesn't allow you to add personal injury. It covers the exact same things. It just gives you a second amount of coverage. Therefore, the word, that's what excess means. So, on the excess policy, this is on the test. You're going to see something called a self-insured retention. And it's on personal injury. Since it's not covered on your homeowner's policy, your umbrella policy, your excess policy will say, pardon me, it's an umbrella policy that covers personal injury. Excess does not. Your umbrella policy will say you have to pay a deductible since your base policy doesn't cover this. And that deductible has a name. It's called self-insured retention. I will try to be as clear as with SIR. You're buying an umbrella policy for an extra $1 million of coverage. The insurance company says, um, we want you to cover $1 million on your homeowners and auto. So we will give you now $2 million of coverage. We'll cover the second million. However, since those policies don't cover personal injury, if you have a personal injury, you must pay a deductible. And that deductible has a name. It's called self-insured retention. If you can just remember that, the questions I've state exams are simple enough. Just remember SIR, self-insured retention, is required when you have an umbrella policy and your base policy doesn't cover something. You have to pay a deductible called self-insured recoverage, a claim that's not covered by your home and auto liability. Um, Umbrella policy can stand alone. You can just buy it on the side. Excess follows form, which means it is going to cover the exact same things your auto and your homeowners covers. But you can just on your own go and buy an umbrella policy. Wealthy people, of course, are very interested in buying umbrella policies. It's not my field, so I don't have many war stories for you. But I was told by a very trustworthy PNC guy that Bill Cosby's umbrella policy or policies paid out $53 million. And so, who would buy $53 million of liability? A wealthy person who wants to protect their wealth would go and consider things like that. But that's not usually anything you or I concern of, just to help you understand. So that, my friends, is our slideshow for auto insurance policies with Baby You Can Drive My Car, Baby You Can Drive My Car, introducing it. Yes, Blanco, the insurance company paid out. Don't ask me why, if the guy was found guilty, but I just was, I got so stunned by the number, I didn't hear the rest of the story. But um, if you have a lot of wealth, you can get sued for much bigger numbers than people who don't have wealth. So you could be totally innocent and get sued for something. If you're a surgeon and somebody didn't like the results, of course that's a different kind of policy, but they're going to sue you for the amount available to them because of your wealth. But uh, would that be considered indemnity? Yes, because that's what was owed. They didn't give that to Mr. Cosby. They gave that to attorneys. Okay? That's what was owed out in bills. So it was indemnity. So folks, couple things. Thanks for attending our little session here today. My name's Peter Lemieux. I'm going to be doing more and more live classes. If I can help you, look at availability and just jump on, take notes. You can get great videos by purchasing Melissa's packages on PNC. Her gold, silver, bronze packages are outstanding. Very, very well taught. She, telling the truth, PNC is Melissa's wheelhouse. She sold it before she started teaching. She's really, really good at it. She can take complex issues and make them very simple. So, our job at Insurance Exam Queen is to help you pass the test. Let us help you do that. So, like usual, likes, subscribes are how we pay our bills. So, if you can do that, that would be much appreciated. My name's Peter Lemieux. You can look for me in the future if you find my teachings have been helpful to you. Are there any other questions before we leave? Well, you folks enjoy the evening and stay healthy. Study every day. Don't skip days as you prepare for the exam. Study something every day. and do the things that Melissa teaches you, you will pass. We get emails every day. Thank you. I was failing until I found you guys. So um, I'm Peter Lemieux, and if I can help in the future, just let me know. Thanks for coming to our class this afternoon. You guys have a great evening.